One of the biggest costs to your retirement might be an unnecessary investment cost that you are paying to big investment firms to have little to zero or even negative impact on your investment and retirement portfolio. Did you know that nearly 9 out of 10 actively managed US large cap funds underperform their index over a 15-year period? You'd imagine that that's their goal, and you often pay the firm who manages the fund. It can range quite a bit, but most likely somewhere between a 0.5% to 1.5%. Yet 90% of the funds in the US large cap category over a 15-year period failed to beat their index. You might think, well, my financial advisor is really smart. He'll pick the right active managers for me. And maybe so, but just know that often leads to performance chasing or the hot hands fallacy, assuming that strong performance will persist. Kind of like assuming the winner of this year's Super Bowl is going to win the next 2, 3, 4, 5 years of the Super Bowl. There is often reversion to the mean. I have dug deep into the data, and the only conclusion I've come to is past performance does not correlate with future results. Now let's look at what this means for you. I'm going to use the US large cap growth category as my example. In this category, less than 4% of active managers beat their index over a 15-year period. So I used a randomizer to select two actively managed large cap growth funds. I looked for at least about a 20-year track record. And they gave me a Schwab large cap growth fund and a Thrivent large cap growth fund. I used a randomizer, so I do not have anything against these companies or these mutual funds in specific, but these are two actively managed US large cap growth mutual funds. Their expense ratio is about 0.99 and 1.01, so let's just call it 1%. Now, this chart shows $10,000 invested in the low cost index fund that does not actively try to beat an index. This is a Vanguard index fund. It simply invests as close to the index as possible, in this case a US large cap growth index, and it charges 0.04% or about 4% of the mutual funds in underlying investment fees. And one thing I should note, when I say underlying investment fees, this is going to be the fee that you never really see. It comes out of the performance of your funds. So say for example on a 1% fund, if that mutual fund, the underlying holdings perform at 10%, they take that 1% fee out and you get paid 9% in this example of a 1 year time period. So when I say an annual underlying expense ratio fee, think that is the company taking that fee out before you as the investor see the performance or see the returns. And here are the results from January 1st, 2016 to September 30th, 2025. $10,000 invested in low cost index ETF. This is a Vanguard one, as I mentioned, would be $49,000. Now let's look at the actively managed funds. They both come to right under $42,000. So to put things in perspective, if you chose the actively managed mutual funds, you paid a 1% expense ratio fee to the investment company and you end up with $7,000 less at the end of it, compared to investing in a passive index fund where you paid about 4% of the investment fee. Now, the analysis I have done on this end for clients and for myself is that it comes down to the compounding effect of that 1% annual expense ratio. Even active managers that outperform the index still have to overcome a nearly 1% annual reduction to their performance compared to the low cost index investment, which is hard to do for a couple years and nearly impossible to do sustainably for 10, 20, 30 years. Another way to look at this, say all else is equal, investment A and investment B. They have the exact same performance, but investment A has a 0.04% expense ratio and investment B has a 1% expense ratio. Now, for example's sake, let's say for 10 years, there's $100,000. They earn 7% annually. Again, the performance is the exact same. The only thing we're changing here is the expense ratio. Here's how it breaks down. Investment A, the lower cost, grows to $196,000 about. And investment B, the 1% cost, grows to about $179,000. So the difference is around $17,000, and this is just accounting for fees. Again, performance being the exact same. So not only does the active manager need to outperform their index consistently over a long time horizon, but it also needs to do this while overcoming a substantially higher underlying fee that is being taken out from the gross performance to get to the net performance that the consumer sees. This sounds like a good deal for Wall Street and big investment firms, but a lousy deal for the investor. Now, I can see an argument for active management in some cases, in some different categories, for some specific people, depending on their risk tolerance. I am not making the point that all active management is bad. But I found a ton of people who did not realize that they were paying a bunch of underlying expenses. Since these fees come out of performance, the average investor can go about their life never knowing that they even exist. If you would like me to look at this for you, I would be happy to do so. I cannot provide investment advice like buy this, sell this to non-clients, but I'd be happy to analyze and provide you with the information so you at least know how much of an underlying investment fee your portfolio is paying. Thank you for listening. Hit subscribe so you don't miss next week's episode. I'm going to do part 2 of the Ramsey mortgage video. I'm going to get into a more personalized example. You can watch that first video here. I'll link it. And as always, money is a tool, knowledge is freedom, and planning is power. Have a great rest of your day.